Hello everyone and welcome to your Glassnode video report for week 37, 2023. So, carrying on with the theme of the last couple of weeks, really looking at this liquidity drought that we are in. And what this really means is that there is low volume, low volatility. Generally speaking, we're seeing capital moving out of the space. What we're going to do today is really explore this from a few different angles, right? We're going to touch back onto derivatives, we're going to touch on volumes, we're going to touch on the on-chain space, and then we're going to look at a bit more about the top heaviness of the market, particularly related to the short-term holder cohort, who, as we know, are quite important because they are the most price sensitive in the space. So what we're going to be exploring today is a couple of metrics which really just carry on with this. I mean, we are in a period of extreme investor boredom. We're seeing volatility and volumes really reach very, very low levels, multi-year lows. We're seeing that there are headwinds in terms of the stablecoin market where we continue to see capital flowing out of the space. And we're also going to be looking particularly at the short-term holder cohort because they really are sitting on the edge of a significant amount of unprofitability. So we're going to explore this mechanic as well as put some pricing models around it, just kind of bound the problem and fully understand it. So as always, please do give us a rate, a share, and a subscribe. It does help this channel get to more people. And without further ado, let's get stuck right into the analysis. Okay, so we're going to start again, just revisiting, because I think this is a really, really important chart. We're going to start with one of these charts we covered in last week's video. What we're looking at here is really, and it kind of backs the whole assumption, or it's one of the many assumptions that we make, to just try and understand the macro scale capital flows. So what we look at here is we've got three different traces. We've got our Bitcoin realized cap, or more correctly, the 30-day change in it. We've got the Ethereum 30-day change in realized cap, and we've got the 30-day change in Stablecoin Supplies. Now, why do we look at these three? Well, for better or worse, the vast majority of capital that comes in or out of this space comes in through either the two majors or through stablecoins. This is generally where capital comes in and out because they are the largest and most liquid. And they also represent the largest majority of all of the market cap in the space anyway. So we covered last week the idea of this risk curve where Bitcoin tends to run, Ethereum then follows, and then we see speculation and capital flow into stablecoins in the green. And in recent weeks, we saw that BTC and ETH really led the 2023 rally. So all of the upside has really been driven by most of the capital coming into the two majors. There's been a persistent decline in stablecoin supplies, and we're going to actually unpick this in more detail just to understand a bit more about the mechanics, because there is a lot going on under the surface. But really the big takeaway message is that stablecoin capital continues to remain negative. We're seeing redemptions on net, and we can see that both BTC and ETH have really cooled off quite significantly. So essentially across the whole board, we are looking at a net capital outflow across all of the three major asset classes. So deep diving a little bit on stablecoins, here we have the total stablecoin cap. Now we're only considering the top five, which is USDT, USDC, DAI, TUSD, and BUSD, right? There's lots of USDs. And what we can generally see is that we've seen about a 27% decline in stablecoin capital. Now, this really started to decline when Luna collapsed. So this was really the start of the deepest part of the bear market. It's when sentiment really shifted towards the seriously negative, right? It wasn't obviously great up here, but it certainly wasn't better following Luna's collapse. And we've essentially seen stablecoin capital flowing out ever since. And down the bottom here, you can see this 30-day change. This is this persistent, long, slow negativity. Now, there's a few reasons for this, and one that we're going to cover a little bit, we actually break them down. But one thing that's really important to remember is that stablecoins are not interest-bearing. And what that means is that we have a risk-free rate in the treasury, right? If you consider it to be risk-free, and we have a risk-free rate in the treasury that's at 5.5%, right, in the United States. And that means that capital is not going to sit, if it has an option to get a 5.5% yield in a US treasury or a money market fund, the opportunity cost of holding in a zero interest-bearing stablecoin really does diminish. And we can actually really see that when we break down the actual stablecoins themselves. On the right-hand side, we've got it in terms of dominance. Out of those top five, what is the overall dominance of each one? And here we have their aggregate supplies. So in aggregate, we are seeing stablecoins flowing down, right? We're seeing the overall redemption. Now, you can also see that under the surface, Tether initially saw a significant outflow, which was picked up by USDC upon the actual Luna collapse, and then 3 hours as well. Now, following FTX, Tether has actually seen a growth in dominance, quite significantly actually. It's actually almost back to its previous all-time high. USDC, on the other hand, is seeing significant capital outflows, and this is actually accelerated through 2023. And in many ways, this describes a bit of a regional divergence. This increase in Tether's dominance is, generally speaking, Tether has found a lot more usage outside the US capital markets. Typically, we saw that a lot of US investors and VCs preferred USDC, and they are the exact same entities who have access to those treasury markets. It is a bit hard to get access to treasury markets if you're outside the US. In many instances, certainly for some of these investors. So we are seeing a bit of a regional shift, and there may be other components to this, but that's certainly going to be a factor. Now we can see that BUSD essentially has gone into redemption-only mode, so it has declined by 89%. So it has fallen quite significantly. DAI really remains very, very stable, and in many ways is just a wrapped version of USDC. And TUSD has seen a very, very minor pickup. It's essentially at the same level, about 2% dominance alongside BUSD, which is obviously going to go down only from here. So you can see that under the surface, whilst there is a net outflow of stablecoin capital, Tether dominance really has picked up, and this is probably speaking, at least in part, to a regional and opportunity cost that seems to exist. Now, this metric is a really interesting one. Generally speaking, when coins flow into an exchange, they're likely to be more immediate. Outflows are a little bit less immediate because people can essentially buy and they can not necessarily withdraw them at the same time. Whereas typically speaking, if somebody's sending BTC or ETH into an exchange, or they're sending stablecoins into an exchange, it is to execute some kind of trade. So what we do here is we net off these against each other, purely looking at exchange inflows. So what it takes is Bitcoin and Ethereum, combine them together on a USD basis. That's what we consider to be sell-side pressure. And when the sell-side pressure of those two majors exceeds the inflowing capital of stablecoins, we consider it to be a net sell side, right? Again, it's a simplistic assumption, but really the absolute value is much less important than the general trend. And we're looking for regime shifts here. When do things start to shift and change? So you can see that the bull market was capitalized by and highlighted by a lot of sell-side pressure. People are taking profits on BTC and ETH, much in excess of stablecoins. Now, naturally, that sell-side pressure is eventually what actually puts the market high in because the sell side overwhelms demand. As we came into that lunar period, right before it, this is where things started to get a little bit choppy. There was a bit of buy side following lunar, there was a bit of buy side following three arrows, but you can see here it didn't really have on the macro scale any kind of trend. It was this uncertain choppiness, and in many ways that was a process of trend continuation. Now, right before we came into FTX, the buy side had really started to pick up. And we've covered this in previous episodes. There was a lot of indicators back here that this had many of the similarities of a typical Bitcoin bottom. And then, of course, FTX really took us down to a new level. And you can see that at that point in time, the buy side picked up significantly. And you can really see that that buy side kicked off the 2023 rally until we got to 31,000. And this is where things moved back into this choppiness phase. And actually, you could argue there's a little bit more net sell side. So you can see that this regime shift really started to kick in. And this is a really nice tool to just kind of balance where capital rotation is starting to happen and when there is a shift and a change in the overall market behavior. So just one of those interesting tools that can help us just gauge where we are and when things start to shift. Now, moving across to look at things like volatility and volume, because I think this paints a really interesting picture. If we look at things from the realized volatility, right, this is looking at how much price is actually moving. You can see that we are at extreme lows, right? We are still, even though we've had the volatility with the grayscale ETF and that sell-off we had the other day back to from 29 to 26,000, and we are down to about 25.1 at the time of recording, volatility is still historically low. We really haven't seen any explosion in major volatility aside from those discrete events. So the market really is seeing this compression overall. And we can see this in the transfer volume as well. We've actually seen Bitcoin transfer volumes drop back to 2020 levels. It shows you just how quiet things are on chain. Very little is happening. And it speaks to this exhaustion, this apathy, and this investor boredom. It really is showing that draining of liquidity over time. We're not seeing anything that resembles any kind of hype cycle. It really is quite quiet across the board. Now, another way to gauge this is by looking at our realized profit and our realized loss. So we obviously have realized loss in red and profit in green. And in the background, you can see the orange, which just combines the two together. Now, why does this matter? Well, when we look at things from a realized profit and loss perspective, one thing is to look at the transfer volume, but the question is, where did those coins come from? Are people, and by that I mean in terms of their price or their acquisition price, are they coming from the $3,000 bottom back here? Are they coming from the $64,000 all-time high? If so, they're going to be realizing a large amount of profit or loss. Now, what we're seeing is that our profit and loss has also collapsed back down to 2020 levels. And this is basically saying that most of the coins that are transacting, the ones that are actually moving on chain, are essentially coming from a price that is very, very similar to our current spot price. The delta between the acquisition price and the current spending price is very, very small. And that again is one of these indicators of low liquidity. The coins that are in a large amount of profit are simply not moving. The coins that are in a large amount of loss simply aren't moving. And overall, it's a really quiet, apathetic, and pretty exhausted market. And again, a lot of these types of things we see following bear markets, it is very much in character of that hangover phase, and it really doesn't give a great deal of upwards or downwards momentum. It's just extraordinary boredom. Now, I'm going to move on to the realized cap hodl waves. So I'm actually going to expand this out onto the full scale chart. And what I've done here, so remember the realized cap hodl waves is kind of the age distribution of the wealth. We're not looking at it in terms of BTC, we're looking at it in terms of the amount of USD invested, the realized price of every coin, how much wealth is held in these different age buckets. Now, what I've got shown here is all of the coins that are under 1 month old, right? So we call this, it's kind of in our hot supply type regime. Now, the reason why this chart is really important is because it actually tells us the story of two sides. A coin cannot be younger than 1 month and older than 1 month at the same time. So the white space in this chart is actually showing us what the old supply looks like, because a coin can only be in one or the other. And what you can see is that our realized cap hodl waves for this hot supply is extremely low. We saw it down here in the 2018 bottom. We saw it here in the 2015 bottom. It got a little bit lower, but back here in the early history is a little bit different. And we saw it on the pre and post FTX period. So what this means is that old coins are simply not moving. So all of the coins that are actually transacting and moving around the system, whilst there's not many of them, the ones that are transacting are from our recent price history. There is just not much momentum in terms of old coins being spent. It very much is the same coins churning around the same price, and it suggests an extreme low in liquidity. It's just another way to think about it, but it is important to note that this is telling us something about both the hot supply, but it's also telling us about what's going on with the not hot supply, right? It's the binary inverse, and this is a really nice way to look at the problem. Now, we see this in our derivative markets too. Futures volume is again back down to our 2020 levels, right? We've essentially flushed out all of the speculation, all of the momentum of the 2021 cycle. It is more or less gone, and we are back down to 2020 levels. Options are a little bit different, actually. Options have seen a net increase over the course of 2023. It's actually trading very similar to how it has through most of well, essentially as far back as our data goes. So the option space is starting to mature. Now, it's important to remember that the overall volume, in terms of open interest, options and futures are very similar in scale now. In terms of volume, note on the side here on the axis, we're talking about $600 million, whereas over here in futures volume, we're talking about $60 billion. So we are talking about orders of magnitude difference. There's a lot more trade volume in futures still, even though we are at the lows. Options are much smaller in terms of their trade volume. But what this really speaks to is that institutions and traders and investors are preferring to use the options market to get that exposure to this asset class without perhaps allocating all of their capital. The asymmetry of an option is it's essentially a 100-to-1 bet, but it's a defined amount of risk. You're essentially putting on the line only the premium for those options to get that directional exposure without having to actually acquire in spot markets or take the leverage on in futures markets. It's essentially another way to get exposure, and it may be that this is actually what's picking up. It's that more capital efficient exposure whilst capital has to move elsewhere, such as out into risk-free rates or any other kind of instrument. So it is an interesting development, and it really is speaking to a gradual maturity of the options market over time. And the last one to touch on with the derivatives is implied volatility in options markets. We are still, right, you can see where this cursor goes, we are still well and truly below where we've traded for pretty much the entirety of Bitcoin's history. We're not quite at, but we are very close to all-time lows of implied volatility. So the market just simply isn't expecting volatility moving forward. And it speaks to this low liquidity regime, a lot of boredom. Now, quite often when we see these low volatility events, it actually signals that volatility is coming. It means the market is essentially not pricing for it, which is very similar to what we saw back there at 29K, right before that sell off to 26. But the interesting component is the volatility almost immediately collapsed back down. We've been trading in this $26,000 to $25,000 range for several weeks now, and it really just isn't moving anywhere. So kind of an interesting development, but we are still not seeing any major uptick in overall volatility in options. Okay, so moving across to the on-chain spaces, this is where we're going to close out today. With all of what we've just seen, let's just summarize the overall view. There's very few old coins moving. Most of the coins that are moving are from a very similar price to where we currently are, and there's not many coins moving full stop. So the chain is very quiet, and that generally would mean, if we were just to, have a guess, that supply is generally speaking starting to age. The hodlers are pretty much the only ones left in the market, and there's essentially no reinforcements coming. That would be, if I only looked at the previous charts, that would be my conclusion. Well, we'll be surprised to know that many of our on-chain metrics are telling us the exact same story. So, long-term holder supply is pushing up to yet another all-time high. It just continues to climb, and this is at 14.34 million BTC. It really is quite remarkable, and our short-term holder supply, which is obviously the inverse of that, is collapsing down to, realistically, this is all-time lows, because the only comparison is in 2011, and Bitcoin was just a different beast back then. So in many ways, what we are seeing is a maturity of coins over time. And in this particular instance of the chart, we've also overlaid a color zone. So the red is showing you which supply is actually classified as short-term holder, and blue is long-term holder. So this uptick, this climbing of long-term holder supply, is essentially showing you the coins that were acquired in the first couple of quarters of 2023. We are seeing these coins that were purchased all the way up, climbing and climbing and maturing across that long-term holder threshold. So it's showing you that the investors in this phase of the market, a great deal of them, are still holding on to their supply. And the takeaway from this is there is a level of conviction. Even though the market's a bit choppy and it's down and we're getting leverage flush outs and it's all a bit chaotic and very boring, the hodlers just don't seem to be fazed by this. It's almost par for the course. And again, we typically see this during these market conditions, this hangover period. It's very, very hard to shake the confidence of the hodlers. It just takes a long time for the process to digest and play out. Now, another way to visualize this is using Liveliness. Now, this is the backbone of the recent Cointime economics report that we released. Liveliness is a really key metric, and it's essentially showing how the supply is aging, or how it actually gets older, younger when coins get spent. It's telling us about these mechanics. So Liveliness will trend higher when old coins are spent and coin days are being flushed out of the system. Old coins with long accumulated lifespan, the hodlers, this will trend higher, and the steeper it is, the more this is happening. It will trend higher when old coins are being spent. The exact opposite is true in the other direction. Downtrends signify the coins are getting older. Hodlers are preferring to hang on to their supply, and they're just simply not spending, which is typical of bear markets, but you can see that this is starting to really accelerate. So the downtrend in Liveliness is telling us much the same as what long-term holder supply is doing. We are getting an overall aging HODLing that is the preferred dynamic. Now, touching on Cointime economics, one of the key innovations from that piece is we believe that we have found what is the more accurate middle cost basis, the true cost basis of the market. And it really does this by discounting all of the lost supply. One way to think about this, if you have Satoshi's coins at a break-even price, right? The realized price is traditionally that cost basis level that we all talk about. But the problem with the formulation of the realized price is Satoshi has $36 billion or thereabouts of unrealized profit. And those coins are simply not likely to respond or move in any instance because we believe that they're lost. So what that means is to get a break-even price, you got $36 billion of profit. you need to have 36 billion of losses from our recent market cycle to offset that, to get a break-even level. So with coin time economics, we essentially filter that out and we come up with what we call the true market mean price. And this particular model has a long-term mean and a long-term median, both of them pretty much oscillating around 1. And they've been that way for a very long time, which shows us that the market likes to spend about 50% of its time above and 50% of its time below. And you can see that we found resistance along this level. It's currently trading at 29,500. And this is really representing that real true cost basis. Where is the average acquisition price of the market? And because it typically trades through the middle, the bull markets typically trade above it, bear markets typically trade below it. And you can see we are finding resistance on it. But in many ways, that should be no surprise. It is that psychological level that still needs to be overcome. So now let's move across and look at our URPD. This is looking at essentially the concentration of coin cost bases. Now, this particular instance we have in the blue, we have our long-term holder supply, and in the red in our short-term holder supply. Now, we've also marked, here's the true market mean price, 29,600, and here's the realized price. This is the model that many in the on-chain space would be aware of. That's kind of what we call the old cost basis. This is our new interpretation of it. And what we can see is that we're just taking the range of what's going on inside this realm. We're more or less trading in the center of it, but you can clearly see that the current price has a lot of long-term holders, and in fact, almost all of them, a lot of short-term holders in red are teetering on the edge. If we get a break lower, all of these coins will suddenly find them, they're already in loss, but suddenly it becomes very acute and they start to really feel that pain. So we really are on the edge of a very, very large supply cluster. Lots of coins have been acquired up in this zone, and this is what you would consider to be a top-heavy market. There's a large cluster of supply that is now held at an unrealized loss, and further downside could motivate that cascade. So in terms of just understanding risk, there is a risk here that we have a large concentration of supply, and we know that the short-term holders are by and large the most price sensitive. They're the most likely to respond. Now, this is likely to be, at least in part, offset by the fact that a lot of people who are still here are going to be the hodlers. Right? These are people who have essentially stepped in the post-FTX world. And as we've seen, there's very little reinforcements coming. It really is a hodler-dominated market. So there will be some component of this where these short-term holders are in fact price-insensitive long-term holders. But again, we just bring it back to statistics. It would obviously be better if price wasn't at the bottom end of this cluster, right? It would be much better if the price was higher up, because then all of these people would be in less financial stress. So just kind of puts one of those things into perspective in terms of a risk vector. So to close out, I just want to highlight how significant this event actually is. So here we've got the percent of supply and profit for the short-term holder cohort. So essentially of all of the short-term holder coins, how much of it is currently held in profit, which obviously the inverse is in loss. And you can see we have fallen from the upper level where pretty much 100% of short-term holders were in profit. Everything was happy days at 31,000. We have collapsed down to just 56%. So in fact, it's lower than that. Sorry, I take that back. That's 15.3%. So that means that 85% of all short-term holders are currently underwater on their position. So you can see that this happened right as we came into the all-time high and we came off that Coinbase direct listing. We can also see it as we started to sell off these large, sharp downtrends. We see it here in 2019. Lots of people buy the local high and then we get a collapse lower. So just helping us set our expectations and understand the mechanics of it, we are now in a relatively price-sensitive mode. There's a lot of investors holding coins which are no longer in profit, and that is going to impact their behavior patterns. And if we just look at this from the lens of the long-term holders, you can see there's obviously a much slower, longer moving process. The long-term holders typically are a more macro style indicator. We started to get some positive momentum, but in many ways, we're essentially very low in terms of the overall amount of long-term holder supply and profit. We typically see this, here we are back here in 2015, 2016. We saw it as we were coming out. We actually were much, much sharper as we came through in 2019. But you can see that, again, there's not many cycles to actually base this particular metric on because typically, there's only been a handful of cycles. But we are in positive territory, but very, very much on the low end. And it very much speaks to we're kind of part way in this recovery process, but it potentially signals that there is a bit of a time component that lies ahead of us, which is a theme that we've been touching on over several recent weeks. So thanks everyone for tuning in for that session. Hopefully you found that useful. Really, just we're sitting in this period of extreme apathy and boredom and exhaustion. Most of the coins that are moving are not really coming from anywhere special. It's just churn. It's the same coins moving around, but we do have that price sensitive cohort in the short-term holders. So, generally speaking, this is the description of a hangover bear market. It does take time for these things to play out. 2019 was a good example of that. 2016 was another good example of that. This is really very, very similar to what we've seen in those prior cycles. And it is, we're in that semi-price sensitive regime. And with low liquidity, things can move with some volatility, right? Generally speaking, low volatility precedes higher volatility. And where we currently sit, we have not much of it. So therefore, there may be heightened volatility with lower transaction volume, lower trade volume, and lower things to slow this market down if it gets moving in either direction. So hopefully you found that useful. Please let me know if you have any comments, and I will see you in the next one. Cheers.